A Canadian company once worth more than every bank in the country combined was gone within a decade, and the executives who ran it into a bankruptcy court are the ones who got away clean. At its peak, this company represented more than a third of the entire value of Canada's stock market. Thousands of employees built their retirement savings around its stock, and its top executives were caught manipulating the numbers not once, but twice, timing the fraud so precisely that it triggered millions of dollars in bonus payments for themselves. This is the story of Nortel Networks. Nortel wasn't always a fraud story. For most of the 20th century, it was a genuine Canadian success, a telecommunications equipment maker that grew into one of the most important technology companies in North America, supplying the networking hardware that powered the internet boom of the late 1990s. At its absolute peak in the year 2000, Nortel's stock hit roughly $124 a share, and the company alone made up more than a third of the total value of the Toronto Stock Exchange. It employed more than 90,000 people worldwide. For a lot of Canadians, Nortel wasn't just a stock. It was a symbol of national economic pride. Then, the dot-com bubble burst. Telecom spending collapsed almost overnight in 2001, and Nortel's revenue cratered along with it. The company slashed its workforce from over 90,000 employees down to roughly 35,000 in a brutal series of layoffs. The stock, which had traded above $100, fell all the way down to 67 cents by October 2002, a collapse of more than 99% from its peak. This is where the fraud begins, and it actually happened in two separate waves. The first wave took place back in 2000 at the very top of the bubble, before the crash even hit. Nortel's finance executives, including future CFO Douglas Beatty, broke accounting rules to pull revenue forward into earlier quarters than it should have been recognized, specifically to meet Wall Street's expectations. But here's the strange twist. They pulled in more revenue than they actually needed to hit their targets. So rather than let the extra revenue show and raise expectations even further for future quarters, they selectively reversed some of those very same entries during the year-end close, essentially hiding away the excess for later use. It's a technique commonly known as cookie jar accounting. Stash extra earnings in a reserve when you have more than you need, and pull them back out later when you're running short. That reserve came in very useful for the second wave of the fraud, which is in many ways the more brazen one. By 2002 and 2003, Nortel, now led by CEO Frank Dunn, with Beatty as CFO and Michael Gollogly as controller, was still deep in its post-crash struggles. But the company had set up a series of executive bonus programs tied directly to hitting specific profitability targets, informally known as return to profitability bonuses. According to the SEC's later allegations, in the second half of 2002 and into early 2003, Nortel's finance team knew the company was facing continued losses. Instead of reporting those losses honestly, prosecutors alleged the executives manipulated the very reserves they'd stockpiled years earlier, releasing them at precisely the moments needed to turn a loss into a reported profit. The timing was almost absurd in its precision. According to testimony at the later criminal trial, Nortel executives reportedly turned an unexpected profit in the final quarter of 2002 into a loss on paper, because that quarter came too early to trigger the bonus payout they were targeting. Then, once the numbers finally lined up the way they wanted in early 2003, the company announced it was returning to profitability, and that announcement triggered roughly $12.8 million in bonus payments to senior executives at a moment when Nortel stock was still trading near its all-time low and thousands of former employees had already lost their jobs. In January 2004, Nortel reported net earnings of $732 million for 2003, its first annual profit since 1997. It looked like the turnaround story investors had been waiting for. It wasn't real. Within months, Nortel began disclosing accounting errors and announced it would restate its results. first blaming internal control weaknesses and incompetence, then eventually admitting the deeper problem. Restatement followed restatement, sometimes announced just weeks apart, unwinding years of manipulated numbers. Dunn, Beatty, and Gollogly were all fired in 2004. The SEC filed civil fraud charges in 2007, alleging both the 2000 revenue recognition scheme and the 2002-2003 earnings management scheme. Nortel itself settled, paying a $35 million civil penalty. Separately, the company agreed to pay $2.5 billion to settle a shareholder class action lawsuit, one of the largest securities settlements in Canadian corporate history. Canadian police laid criminal fraud charges against Dunn, Beatty, and Gollogly in 2008. But here's where this story takes a turn that's different from almost every other case we've covered. When the criminal fraud trial finally concluded in Toronto in January 2013, nearly 9 years after the executives were fired, the judge acquitted all 3 men. The court ruled that prosecutors hadn't proven beyond a reasonable doubt that Dunn, Beatty, and Gollogly had deliberately misrepresented Nortel's financial results. Frank Dunn called it a vindication. By then, it didn't matter much to Nortel itself. The company had filed for bankruptcy protection back in 2009, unable to survive the combination of the accounting scandal's fallout and the brutal aftermath of the tech crash. What remained of Nortel was liquidated piece by piece over the following years. Patents, business units, entire divisions sold off separately to competitors around the world, eventually raising close to $8 billion, all of it going to pay back creditors rather than rebuild the company. By 2017, Nortel Networks, once worth more than a third of the entire Toronto Stock Exchange, no longer existed at all. What makes Nortel such an unusual case in this series isn't just the scale. A company that large essentially vanishing, it's the ending. Most of the executives at the center of the biggest frauds we cover face prison time or massive personal penalties. Here, after nearly a decade of investigations, restatements, and a criminal trial, the men accused of timing a bonus scheme around a manufactured return to profitability walked out of court free and clear. The company they ran didn't survive. They did. Everything I use to make videos like this, scripts, tools, more stories. LineLoopSoftware.com. Tomorrow, the bank that hid its losses in a fake reinsurance company for 30 years.